Hi, this is Introduction to Accounting Part 2, and we're going to be looking at the balance sheet and some of the balance sheet definitions. Okay, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to the presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at this email address to discuss. Note the author does not claim any copyright whatsoever in any companies or organization mentioned in this presentation. Other parties, rather the other parties are their owners of their respective copyrights. So when we start going through the first part in terms of learning how accounting works and how to learn and understand accounting, I take a very different approach, which is trying to focus on the balance sheet first. And when we're looking at the balance sheet, which is really the final product of, this is the last statement we prepare of the primary financial statements, which we income statement, statement of retained earnings or owner's equity, and then lastly, the balance sheet. We're going to be looking at this first, but again, my goal is to have you become familiar with how to record balance sheet transactions, because then when we start going through and preparing other transactions, we're going to be doing it basically on multiple dates throughout the year. So we're going to suspend reality as we're going through and doing some of these transactions, and most of these will be taking place, or at least for the first part, while we're learning, all on December 31st. No company in their right mind would ever be doing everything on December 31st. It's just for learning purposes, it's a much easier way of dealing with it. Okay. So our grand equation, and the equation that we're going to be focusing on during this presentation, is our assets are equal to our liabilities plus owner's equity. This is a snapshot in time. It's telling us at a certain point in time, like we take a photo and we say, what are our assets? What are the liabilities that have the claim on those assets? And then what is our owner's equity? And let's kind of take a look at each one of these. And this is really, when we say our assets are equal to our liabilities plus owner's equity, this is really what we call the grand equation. And if we look at any publicly traded company, we're going to see that the company's balance sheet reflect total assets, and this will be equal to the total liabilities plus owner's equity. And the balance sheet, again, is a snapshot. It's one day. And one of the things I do is I encourage, and one of the things I like to do as an instructor is on the first day of class is have my students tell me, okay, I want to look at Amazon, or I want to look at, a different company. And let's just kind of go through here, and we can pull up, we can go here, go over to Snap. Okay, so this here is Snapchat, and let's take a look at their balance sheet. And so their balance sheet here is as of December 31st, 2017. They also have one here for December 30th, 2018. But if we look at September 30th, 2018, their total assets were $2.7 billion. Now, when we look at their total assets, we're going to say, how are those assets owned? Meaning, what are the liabilities against those assets? And then the remaining amount is what is owned by the owners. So right here, when we look at the assets of Snap, they've got about $2.7 billion in total assets. Snap has liabilities of $399 million, and then they have owner's equity of $2.3 billion. When I add $399,684, or the total liabilities plus total stockholders' equity of $2,384,092,000, this is going to equal $2,783,776,000, which is the same number that's right here. Whenever I'm looking at a balance sheet, and if I don't balance, I have a problem. Okay, my total assets must equal my total liabilities plus my total owner's equity. Every company, this is going to be different. Every single company is unique. They all have different types of operations. They have different types of accounts and the like. But at the end of the day, their balance sheets have to balance. If I filed a balance sheet that didn't balance with the Securities and Exchange Commission, they would be sending me a notice within about 5 minutes saying, hey, Tchaikovsky, it's not balancing. What are you thinking? And then I would have to suffer that embarrassment, and I would never do it. So again, it's something that just to kind of remind ourselves that assets must equal our liabilities plus our owner's equity. So, again, so take a look. And so kind of a visual of this, if we looked at assets as a globe, right? If I look at this as a big circle, right? And these are my assets, the inside here tells me how these assets are owned, right? Are there claims on these assets or liabilities, or unfulfilled obligation represents what the company owes to creditors or other parties? And then you have here owner's equity. After the liabilities have been satisfied, what do the owners own of the company? I realize that this looks like it's 50% on each side, but it's not necessarily going to be that. You could have a company like Snap, which was 400 million and 2.3 billion. So it just depends on the company that you're looking at. But what exactly, and so if we're saying that assets are the globe and then liabilities and equity, so what exactly are these different, what are these different things? What is an asset? An asset is owned by the company and gives the company future economic benefit. We are generally only going to be recognizing assets as a result of past business transactions. And just kind of remember that when we're looking at transactions for a company, we're really, in financial accounting, we're really looking at the past. Managerial accounting is more focused on the future, but here in financial, we are recording past transactions with a consideration for some future items. When a company says our employees are our greatest assets, this is not an asset in terms of financial accounting. Rather it's a way of making employees feel relevant, loved, and treasured. It's not, and when a person is referring to body parts as assets, that's really not, it's not the asset in the sense of the financial accounting definition. And again, when you're looking at different types of companies like Facebook carries no inventory. Our personal information is not inventory yet, while a company like Lowe's does in fact have inventory. Some examples of assets. What I would do if I was starting out in accounting is like, the way you're going to learn accounting is by doing problems. I'm giving you these different examples so you can kind of come back and refer to this later on. But here are some kind of common types of assets. And, this is what they are. So you have here, you've got cash. A company is using cash to acquire other assets, settle liabilities, pay dividends to shareholders, or pay wages to workers. It's cash. It's a medium of transaction. Cash is an asset because we can use it to buy other assets, or we can be using it to pay wages. And we'll get into that a little bit later. What exactly is an account receivable? If I performed work for a client, or if I've provided goods to a client and I have not yet been paid, this is what we call an account receivable. And so the key is here with an accounts receivable, I have to have done the work or provided the service. If I haven't done the work or I haven't provided the service, it's not going to be an account receivable. Inventory. When a retailer or manufacturer sells inventory to its clients, inventory here is ultimately sold and converted to cash, and everybody has different types of inventory. So for a company like Home Depot, inventory includes toilets, shower doors, lumber. If I am, what's another good example? If I am Forever 21, it's clothing is going to be in my inventory. If I'm Target, it might be household items. Again, it's really going to depend on the type of company. Here are some more examples. Prepaid expenses. If I'm prepaying for service or for coverage, such as insurance, this is prepaid expense. So if on December 31st, 2019, I am paying for an insurance policy that covers from January 1st, 2020 to December 31st, 2020, or a coverage in the future, this is what we call a prepaid expense. I'm paying for something now that I'm going to be getting the benefit for later. And insurance is a great example, because if we didn't prepay for our insurance, if nothing went wrong, then we wouldn't pay the policy premium. So another type of asset is an intangible asset. This is what happens here is if a company acquires a trademark, copyright, or patent from another party, or if a company is defending its existing copyrights, trademarks, and patents, these are referred to as intangible assets. Great example, when Disney acquired Marvel, one of the intangible assets was more than likely some of the certain characters that they or the properties that they assigned value to. Iron Man, when they acquired the Star Wars franchise, I always like to use the example of Han Solo being allocated a couple $1 million and Jar Jar Binks getting nothing. But again, an intangible assets can have huge amounts of value just because they can be recognized. But it's really, again, what is an intangible asset? It is a property really without any kind of physical substance. Goodwill represents the difference between the purchase price and the fair value of assets received when a company purchases another company. And I'm giving you more examples of assets right now. We're not going to be using, for example, in my examples, I'm not going to be using patents, goodwill, and mainly because we're going to explore those in later chapters. But I do want you to be aware of these different types of assets. Property, plant, and equipment refers to land, equipment, or buildings that are owned by the company and they are currently used in the company's operations. That last part is very important. It has to be used in the company's operations. Marketable securities, if I have excess cash and I don't want it sitting in a bank, I can invest it in short-term investments, stocks or bonds. And again, these are assets because they can ultimately be liquidated for cash. What is a loan receivable? If I've given money to another party and it's going to be repaid by the other party, this is what we call a loan receivable. What is a note receivable? A note receivable is if a company is selling equipment or other products and the purchaser is not paying all at once, rather placing the balance on the note. This will be referred to a note receivable, basically for that equipment. Interest receivable. If I've loaned money to somebody and I'm charging interest and that company has not paid the interest, then that's what we call interest receivable. We have other assets, which are anything that doesn't really fit into any of these other categories. Deposits, again, that can be like a prepaid item, like prepaid consulting fees. So those are examples of assets. And most importantly is don't say a person is an asset. Assets usually happen as a result of past transactions. So again, asset is something that is giving us future economic benefit. Okay. So here, this is kind of just, I kind of talked about this Macy's example earlier, and then also over here with Lucasfilm. But again, when a company is saying our employees are our greatest assets, that is not an asset in the financial accounting standpoint. Let's take a look, and remember our equation is our assets, or those items that are given future economic benefit, equals liabilities plus owner's equity. So let's kind of take a look here. So these assets here are the globe, meaning what do we have that are giving, what's giving us here, what is giving us future economic benefit. Then when we look inside there, what are liabilities? Well, liabilities are examples of, say, accounts payable. I've received items, but I have not yet paid for them. I need to be paying for them later. I'm going to pause really quickly and show you an example of a company that has accounts payable. Oh, and we're back, and we're taking a look at liabilities. And so I've pulled up the quarterly report for Lowe's. And this was their most recent quarterly report as of the making of this video. So here's an example here for Lowe's. You see here they've got cash and cash equivalents, short-term investments, inventory, property, plant, equipment, long-term investments, goodwill, and the like. Again, every company is going to be different. When I look down here at the liabilities, I see here accounts payable. What exactly is this? Lowe's has received inventory but has not yet paid its vendors for that inventory. Lowe's, as of right now, has $9.2 billion of accounts payable. Here's another example here, accrued compensation and employee benefits. This is what we call an accrued liability. And it's different than the accounts payable because the accounts payable really arises out of inventory type transactions. Either inventory or somebody's provided a service for me, and that's really, it's a payable. The accrued liabilities is that this could be something like accrued compensation, accrued bonuses, it could be a lawsuit. If I've had an obligation that I need to pay, but I have not yet paid for it, it doesn't fall under the payable side, it's more than likely going to be an accrued liability. What is a notes payable? It's the opposite of notes receivable. I have gone through and I've either purchased equipment or I have borrowed money on a short-term basis, and I have to pay somebody later. So if I purchase equipment, I receive equipment, and I issue them a note, that's what it could be. Again, when you're first going through and learning accounting, it's more important that you recognize the liability, not necessarily how it's classified. As you go through and do more and more problems, you'll get better at it. It's just practice. Over here, we've got bonds payable, and bonds payable is a specific type of a debt. I can issue a bond. It's really used for fundraising, or for essentially it's for financing. Interest payable, if I have borrowed money, but I have not paid the interest on that, then that's going to be an example of an interest payable. Unearned revenue, advances from customers. I've received funds from my customers, but I have not yet provided them the goods or the services. I'm going to pause real quickly and show you an example of a company that has this. If I take a look here at Tesla, and remember we were going through some liabilities and kind of looking at different examples. But if I go here and take a look at Tesla, what I see here in Tesla is when I go down to their current liabilities, I say here, oh, there's deferred revenue, and then there's customer deposits. Now, if I wanted to see exactly what those were, I could go back and look later, but what would a customer deposit be? Somebody has given me, someone gave Tesla a deposit essentially for a Model 3 or one of their future automobiles. So today, Tesla has customer deposits totaling about $905 million. Deferred revenue, if Tesla has, for example, if they've received money, say for future auto upgrades from a customer, then they have to call that deferred revenue. Deferred revenue is they've received money, but they have not yet performed the service or provided that to the customer. The customer deposit is somebody has given money to the company for a future, essentially for a future purchase. Again, those are both examples of liabilities where the company has received money but has not yet performed the service yet. So going back over here, what is a warranty liability? A warranty liability is that if I purchase a car, so if I'm Ford and I'm warranting my vehicles for a certain period of time, I could have a warranty liability on my balance sheet, meaning I have an obligation to a customer that a car will function in a certain way. Owner's equity. So again, we've looked here, what are the assets? That's everything that's giving us future economic benefit. And how are those assets owned, right? Well, there's a liability, right, which is what are the unfulfilled obligations? What does a company owe to its creditors and other parties? And if we deduct that out from the total assets, we're going to get to owner's equity, or what portion of the total assets do the owners own? And if we go down here to look at owner's equity, what we can kind of see is what are the different types of accounts. The only one you're going to be really concerned with on this next go around for these questions I'm going to be going over is common stock. Common stock represents ownership in a company. And there are different items you'll see later on called common stock at par or additional paid-in capital common stock. Those are just different ways of kind of saying the same thing. We'll be exploring that in a later chapter. But common stock represents ownership in the company. Preferred stock is a stock that can give holders special benefits or treatments as to dividends, participation, or conversion. These are generally investor driven, meaning an investor goes to a company. If you want me to invest in your company, I want stock that has these preferred treatments over common, so I have additional protection as an investor. What is treasury stock? Treasury stock is stock that has been repurchased by a company, and it's essentially shows as a reduction to owner's equity. For my class, you only need to be concerned about common stock. These other two parts right here, I'm not as concerned about these right now. I'm just putting these out there because you will see them on financial statements. So here, treasury stock is basically common that a company is repurchased. Other gains or losses, this is typically used for foreign currency translations. Retained earnings. This is something where a company has had net income and they have not distributed it yet to the shareholders. Very important when you hear dividends, dividends are not an owner's equity account. Dividends, rather, they reduce retained earnings. They are not an owner's equity account. And when I say owner's equity account, meaning something that you will see on the balance sheet. So I'm going to pause really quickly and we'll take a look at another company and take a look at their owner's equity. Thank you, and we're back. And now we're going to look right now at the Home Depot. And when we look at the Home Depot, and this is terms of their owner's equity, here we've got their assets of about $46.2 billion. And down here, we kind of look at their liabilities, about $44 billion. And when you look over here at the owner's equity, you see here we've got common stock, we've got paid-in capital. And does owner's equity mean the same thing as stockholders' equity? Absolutely, yes. A lot of times when I'm using terminology, you'll find different people are using different things. But let's go ahead and take a look at this here. So they've got retained earnings as $43 billion, and then they've got an accumulated other comprehensive loss, which again may have come from foreign currency translations. I don't know. The way I would find out is I would go down here and look at the footnotes to the financial statements. These financial statements I'm looking at are pages upon pages long and would give us a much more comprehensive look. But right now, again, I'm trying to make sure you're not drinking out of the fire hose. I want to introduce this a little bit at a time. So here we've got treasury stock. And as I said, what is treasury stock? A company's gone out and bought back their own shares. So that's what treasury stock is right here. So that's kind of another example of an owner's equity type account. Now let's go back here. So that brings us to the end of our presentation for today. I want to thank you for watching this video. Please do not forget to like or subscribe. And if you have any questions or comments, please feel free to send me an email to bennett1812@gmail.com. I welcome your comments, and I will see you on the next video. Thank you.